In this video, I want to talk to you guys a little bit about the concept of leverage as it relates to finance. This is a term that's used a lot in a lot of different ways. I'm not going to cover all the different ways, but it has a very specific meaning as it relates to thinking about the riskiness of a company and the financial structure of the company and all that sort of stuff. And so that's what we're going to cover today. So I want to start just with the general concept, which really comes from something called mechanical leverage. And that is very simply the concept that using a lever in a particular way, you might be able to get more lifted or raise a weight that's of a greater amount with the same amount of pressure if you're smart. And so, kind of the way that works is basically says, think of this as a board that or a plank that is sitting over a fulcrum, and about half the length of the board is on one side, half on the other side. In that case, if you wanted to lift 100 pounds of weight, you would need to push down 100 pounds on this side. However, if you shift the lever so that more of the lever is on the side that you're pushing down on, then you can actually use the same amount of pressure to lift more weight. And in fact, the sort of ratio here, the idea behind it is that whatever the ratio of the length on this side to this side is, that's how much more weight you can lift. So in this case, this is 2 times as big as this, and so with 100 pounds of pressure, you can lift 200 pounds of weight. Okay, and so that's kind of the mechanical concept, is that we're able to get a bigger result in terms of the amount that we lift with the same amount of effort in terms of the push that we put on it because of leverage. In finance, it works kind of similar. The thing that we're trying to get, right, the result we're trying to get is usually earnings, whether that's earnings per share or total earnings. But the lift, the effort we have to put in is to go get sales. And so leverage speaks about, at the highest level, about the change in the earnings given a particular percentage change in sales. And so again, very much like before, there is a concept of leverage that is equal to 1. And in that case, if I were to, for example, do the work to get 20% increase in sales, I would expect to see a 20% increase in earnings. Whereas if I set my company up differently and have a different amount of leverage, the work I do to get a 20% increase in sales could give me a 40% increase in earnings. And so doing the same work to get the sales, but have twice as much change in earnings. So that's kind of the concept and why it intrigues people. When we talk about it in that context, we're really talking about very specifically something called degree of total leverage. That's also sometimes called DTL. I'll refer to it as DTL throughout. So that's what you'll know as I'm talking about the total leverage. It measures the percentage change in earnings for a given percentage change in revenue. As in our example, the lowest possible DTL you can have is a DTL of 1. This would occur if you had only variable expenses, no fixed costs, and if the firm was 100% equity finance, so that you also have no fixed interest payments. There is not really any concept of a maximum possible value for DTL. Theoretically, you can see firms that have DTLs that are, 100. But it's somewhat unusual to see healthy firms that are set up with DTLs in excess of 4 or 5, just because the higher DTL makes it so much more risky as a firm. Again, as we talked about before, the DTLs for a firm with a firm with a DTL of 1, an increase or decrease in revenue gives you the same increase or decrease in earnings. And so it does work both ways. It's symmetric. Whereas if the DTL increases to 2, then the same amount of earnings gives you twice as much increase or decrease in terms of the change in the earnings versus the revenues. And so, that symmetry basically means that higher DTL implies that the company has a higher variability of its earnings. And I use the term here ceteris paribus. That's a Latin term that means all other things being the same or comparable. And so it means, assuming you don't change anything else about the company other than the factors that drive the level of DTL, that's what you would see. So I've created a little example, spreadsheet example for you that hopefully will work. Had a little problem getting this one to work properly, but starts out with a company that's got $10 million in the base case of revenue, has a DTL of 1 and earnings of $5 million, and so about 50% of the money goes from revenues to earnings. That's pretty good. And because it's got a DTL of 1, what we should know is that if the revenue goes up by 20%, the earnings should go up by 20%. That's what's predicted by this. And if the revenue goes down, the earnings should go down. Well, you can see here that the revenue goes up, the earnings go up proportionately, right? And again, because all of your expenses are variable expenses, that would mean that you got basically a 50% cost and the other 50% is revenue, and so it just goes up proportionally. And sure enough, based on that, your earnings go up by $1,000, $1 million versus $5 million, so up by 20%, or down $1 million versus $5 million, so down 20%. Now, the real interesting thing happens if you put in a leverage, a DTL of higher than 1. So if I put in 1.5, we've now got a 20% change here, but we're getting a bigger bump in terms of what's going on down here, right? And the real question is obviously why, but we are in fact seeing that this increases the earnings. Now, clearly, the only way that it can do that, if you stop and think about it, is instead of there being a sort of straight relationship here where when I increase this, that my expenses go up by half, they're going up by something less than half, right? And that's partly because some of it is fixed cost. But by the same token, when my revenue goes down, instead of expenses getting, still being at half, expenses stay a little bit higher, and so we're left over here with a little bit less left over, and so that's what's causing this. All right. So if we want to get down to brass tacks, sort of the way that you calculate this quite literally is you are saying what's the change in earnings for a given change in revenue on a percentage basis. Looks just like the spreadsheet we did. There's two different contexts in which you might do that. Some people just use a year-over-year comparison, and so they may look at a company and basically say, this year their revenue was this much and their earnings was this much. Next year their revenue went up by 10%, their earnings went up by 15%, and therefore that suggests that they have a DTL of 1.5. The hard thing about doing that, quite frankly, is that oftentimes other things will have changed, and so it's not really a fair comparison because things other than the revenue have changed. You may have had different, you may have refinanced or done something different with your debt. You may have made some changes or had some other expenses come in or not show up in terms of your operating income. And so it's a little bit hard to make that as a one-to-one comparison. The more common way for us to do that is that we'll build a model based on what we understand the operating principles of the company to be, what their fixed versus variable costs are, what their interest is, all that sort of stuff. And then we'll stress that model by changing the revenue and seeing what happens to the rest of it. And so again, kind of an example of that, I have company A, which we've already looked at, and rather than just doing the straight calculations, I actually went in and sort of built the model, if you will, for it. Now, it's not exactly the same as the last one, but here we've got it, and we basically saying, again, let's just take a base case of $10 million. We know that it's got a variable cost of 30%. that their fixed costs are running about $1 million, that they require a $50 million investment, sort of capital, debt, and equity, if you will. Not particularly important to you, just want you to be thinking about that. And that they're paying an 8% interest on the debt, and therefore, every year their interest expense is going to be 8% of that $20 million in debt. And so in the base case, if you kind of follow that through, $10 million in income, 30% variable cost means $3 million in variable expenses, $1 million in fixed. So you have a net operating income of $6 million. Interest expense of 1.6, you wind up with 4.4 million. Got taxes on that, which I just did at 25%. You wind up with 3.3 million. So that's the base case. Now, with with this particular company, let's just do the shift in revenue and see what happens to the earnings, right? And that's going to give us a bit of information, I guess, that would be useful for us. So first thing that we're going to do is, again, we're going to go and we're going to say, okay, let's just look at, with this 20% shift, revenue goes up, variable costs go up because they're supposed to, fixed costs don't, interest expense does not. So we wind up with earnings before tax of $5,800. We pay our tax on it. We have a net income of $4,350. Okay, and so our change is we went from 33 to 43, 3,300 to, or 3.3 million to 4.35 million, right? And so what we want to know is what's our change in net income, and so we're just taking, that change. So the, 1.05 million over the 330, and that's a 31.82% change. Okay, so for a 20% change in net income or in revenue, we got a 31.82% change in net income. So revenue of 20%, net income of 38 or 31.8. You just divide those two, and that gives you a degree of total leverage of 1.59. And now that you have that, it really doesn't matter what we change these scenarios to. We could change them to 30%. And we would still know, without having to go through all of the recalculations, that we could just take 20%. That's what I did here. You just took the the change in revenue, so 30% times 1.59. That equals 47.73%. And so that's how much your earnings are going to change because your revenue changed. Okay. So again, kind of a cool thing at this point. There's not a lot of insight into it yet, but kind of a cool thing to be able to sort of do that sensitivity once, if you will, and then just be able to use the sort of simple percent change in revenue versus the total leverage to figure out what the variability in the earnings is going to be for a bunch of different scenarios. Okay. So, very cool and all, but what we really want to do is kind of dig a little bit deeper and understand what's causing the DTL to be what it is. And there's a number of different things that we have to consider here, but we're going to kind of take them a piece at a time. So the first thing that's going on is the variation in revenues. Remember that we are sort of arbitrarily saying to you how much the revenues are going to be, or are going to change, all right? And so that sort of variation, if you will, this is probably better described as sources of variation in earnings, but we'll go with this. That variation in revenue could either be because of systematic factors, like we've talked about before, or it could be firm or industry-specific factors. Lots of things could go into the variation of the revenue, right? If we only considered the variations due to systematic factors, then we could use this to sort of determine what the systematic variation in earnings is. Now that doesn't get us to stock price, but we can be pretty confident that when earnings vary, that stock prices vary in a sort of predictable way. And so we could imagine that there might be a link there. Again, if we consider everything, then we get the total variation in the total in revenue and earnings. But basically what happens here is, so you start out with a variation in revenue, and then based on the mix of your fixed versus variable costs, that results in something called the degree of operating leverage, okay, which tells you how much your net income, net operating income, so just revenue minus expenses, operating expenses, it tells you basically how much your net operating income will change for a given change in the revenue. So same sort of concept. If you know the percentage change in revenue and you know the degree of operating leverage, you know what the percent change in net operating income is. And then the second thing that happens, you go from the net operating income, remember below that line you now have your interest expense. And so depending on what your debt to equity mix is, or really more specifically what your interest expense is, that's going to affect your degree of financial leverage. And so degree of financial leverage talks about how for a given percentage change in your net operating income, how much of a change in earnings percentage-wise you're going to have. And so by breaking that DTL down into its different pieces and understanding how that all fits together, that starts to give us a picture of what's contributing to the variability in earnings and therefore what we might be able to do about it. All right, so let's talk about those pieces individually for a second. First one that we talked about was the degree of operating leverage. I'm not going to talk too much about the variability in the revenues because we've sort of covered that in our discussion of risk. But let's talk about degree of operating leverage. Formula for that is the percent change in net operating income divided by the percent change in revenue. Again, the lowest degree of operating leverage you can have is 1, and that's when all of your expenses are variable. And so we saw that example before, kind of overall, that when the expenses are variable, that as the revenue changes, the bottom line, the income changes proportionately, and so there you go. And the degree of operating leverage increases as the proportion of expenses that are fixed increases. So the greater the amount of the expenses that are fixed, the more the degree of operating leverage is going to increase. Now, you might ask yourself, why would a company go out and target a degree of operating leverage higher than 1? I mean, that's like just taking on risk. I don't really understand it. And the bottom line is that a lot of times it's got to do with a situation or a strategy or whatever else. Kind of give you some examples. Startup companies, when they're very young and they're not sure how their revenues are going to go and all of that sort of stuff, they tend to like to have less fixed cost and more variable costs that vary with their revenues, so that if the business doesn't materialize, they're not sitting on top of a big fixed cost that they have to cover. And so as a purely risk management standpoint, they will do what maybe your intuition says and try to keep their degree of operating leverage close to 1. But let's say that you're a company that's pursuing a strategy we call a low-cost leader strategy. And in that strategy, what you want to do is you want to drive your variable costs down as low as you possibly can, so that as you sell more, it doesn't keep costing you more to sell it. And so you want to shift as much to fixed cost as you can and as little to variable cost. Well, doing that by itself is going to give you a high degree of operating leverage. And then the other thing to consider is sometimes it just has to do with industry norms. Depending on the kind of industry you're in, you just may not have that much variable cost, or you may have a lot of variable cost. And so kind of two extremes that come to mind for me. If you look at a service business where, maybe like a restaurant business where, the one of the biggest expenses is food and labor costs, and those tend to vary pretty much proportionately and are managed proportionate to the sales. And so those are the kinds of businesses that in those industries inherently have lower degree of operating leverage. Whereas if I think of something like maybe the software business, I spend a lot of fixed cost up front to write something. And then, quite frankly, the variable cost of producing the next copy and the next copy and the next copy of it for people is almost nothing. And so that would have a very, very high degree of operating leverage. The second piece of that is a degree of financial leverage. We call that DFL. And that is the percentage change in earnings given a percentage change in net operating income. And so I will tell you that having looked out on the internet, there are some examples where instead of using the change in earnings, they use the change in EBIT, so earnings before interest and taxes, and they add back to that basically the interest. They subtract from it the interest, or they might alternatively give you the final, the EBT and add back the interest. There's just different things that they do. But the bottom line is that the only reason that they're doing something different there is they're concerned about what would happen if the effective tax rate for the company were to change from one period to the next. Otherwise, if the tax rate stays the same, you get the same result either way. So we're just going to go with sort of the simplified formula here. Just like with the degree of operating leverage and the DTL, the DFL, the lowest it can go is a 1, and you get that when you have no interest expenses, which I assume means no debt, because I'm assuming that nobody's going to loan you money and not charge you interest on it. And it increases as the proportion of interest to net operating income increases. And so if you think of it in terms of how much of the net operating income is available to cover the interest expense, the higher the net operating income is relative to the interest expense, the lower your degree of financial leverage will be. As the interest expense becomes higher, that goes up. So, why would a company target a given degree of financial leverage? Well, the conventional wisdom would basically say, don't I want to keep my debt and my interest expense low so that I don't have to worry about not being able to make that interest expense? But the truth is that keeping your debt low keeps your return on equity low. And I'll give you an example of that here in a minute. All right. So one of the reasons that companies target a higher DFL is that their investors, their equity investors, want a higher return on equity. And so they're forcing them to take on more debt in order to get the return on equity up. You should note, though, that even though that's something that equity investors and boards of directors do, that as we've talked about, if you're increasing your DFL, then you are increasing your systematic risk, the level of it for your earnings. And so that risk means that the investors now need a higher required return just to justify the risk. And so it leaves you with a question of, are there any benefits in terms of improved market value of equity for a given level of DFL? Or is this really, as the options valuation view of the value of equity, is this really something where the equity investors want the increased risk, right? And so they aren't penalizing you for more risk. They want the return and they want the risk, and so they're getting both of those. So that's a theoretical question. Don't know the answer to that one. Nobody really does, unfortunately. So I want to kind of put all that together here, and then I'm going to walk through a spreadsheet example, kind of play around with it for you. Let's just talk about kind of the 4 elements: revenue variability, degree of operating leverage, financial leverage, and DTL. Let's think in terms of the earnings risk of a firm. So how much risk is there? And let's just think in terms of standard deviation. So we know that we can get to the earnings risk by just taking a variation in revenue percentage change times its DTL. So let's just think in terms of the standard deviation of revenue as being 15% of whatever the base is. So, that means obviously it's somewhere between plus or minus maybe 45%, but that's its level. And let's say that it has a DTL of 3, so overall total leverage of 3, then we could very quickly basically say, and I don't know why that's a 2, I'll fix that, but we could say 15% times 3 equals 45%. I'm going to go ahead and fix that now. Sorry about that. I'm a stickler for getting my stuff right. Just wish I'd gotten it right before we did this. Oh well. So we put the 3 in there, it's 45%. Now, the other thing, not sure you realize that, but DTL can be calculated as degree of operating leverage times degree of financial leverage, so DOL times DFL. So let's just say that I have a DOL of 1.5, DFL of 2. Multiply them together, you get 3. So that's where that 3 came from, is we have a little bit of operating leverage, but a fair amount of financial leverage in this particular company. That's what got us to a 3. And so we could also basically say that the standard deviation of earnings is the percent, the standard deviation of revenue times the DOL times the DFL. You still get to the 45%. Now, I've put together again something so that you guys can play with it in terms of a spreadsheet. I've put together an example here that's a little bit more fleshed out. It actually does the calculations for degree of operating leverage, degree of financial leverage, and the DFL, or DTL, sorry. And it does that calculation both by basically dividing the change in earnings by the change in sales, and also by just multiplying the DFL times the DOL, so that you can see that it works both ways. And again, it's the same sort of situation as before, but if you wanted to play around with it, you could, for example, say, oh, let's again, here we don't change that percentage. What we do is we go in and we might say, oh, let's say what happens if we moved our variable cost down to, say, 20%. Well, by moving it from 20%, you went from a 1.59 to a 1.48. So by lowering your variable cost, you lowered your total leverage. All right. So you can kind of play around with it that way. All right. What I also did, which I think is probably a little bit easier to see, is I've set up 2 firms. It's all the same setup except for that it's 2 firms instead of 1. So you can think of it as Company A versus Company B, or you can think of it in terms of Company A set up one way and Company B set up another. And so here you could just say, oh, let's change the thing to 20%. And what you see is, looks like this one's gone from 1.59 to 1.48. The degree of operating leverage went down, which we would expect. We also got a little bit lower degree of financial leverage. Now, that one's always tricky when we talk about the why. The short answer to that is that we've actually changed our net operating income at this point, right? If we had made some assumption that would keep it the same, keep it at this same $7,000 or $6,000 level instead of $7,000, those would kind of straighten themselves out. And so we could say, let's go put $2 million in here. And you see when we do $2 million now, in the base case, we're still making $6 million of profit. We're just making it a different way. We're making it with higher fixed cost, sorry about that, and lower variable cost. And so in that case, you can see that the total leverage goes up. The operating leverage went up, right? Which is what we would expect. The financial leverage did not go up because we didn't do anything with financing. And so again, when you multiply this times this, you're going to get the higher DFL. So there, when I used that term ceteris paribus before, all other things being equal, in an example like this, part of what you have to make sure is equal is that if you're going to lower something, that somehow you replace it with something else in the base case, right? In order to basically say, let's just say we could do that and maintain our same cost structure. Now, to be fair, when you're doing this to try and figure out how to improve or modify in some way the riskiness of a company, you're not held to that same constraint. If you can find a way to lower your variable cost without raising your fixed cost by the whole amount, so maybe it only goes up a little bit, then it is what it is. And the fact that it makes everything change a little bit is correct. You don't have a math error there that says, wait a minute, why is it that my financial leverage changed? You know, just assume, just take it as it is. It is correct. Okay. Now, part of the thing that as I said, that you might be interested in understanding on this is, why would someone go to the trouble of maybe raising their leverage, right? Well, by raising the degree of operating leverage here, as we just did, what we did was basically make it so that the same 20% change in revenues bumped us from, instead of having a 14.5% return on equity, we now have a 15% return on equity. Now, of course, when things are bad, it goes down to 7%. So that little bit of change made a difference, all right? Where that really kicks in is when you play around with the financial leverage. So again, required investment of 50. Let's just say that instead of financing at 20% with debt, or 20 million in debt, we do it with 40 million. Okay? That kicks us up quite a bit. Now all of a sudden, you know, that little bit of a change, we went from an 11% return on equity to a 21% return on equity. Now, granted, we have a much bigger swing now in terms of how much, when revenue changes, it impacts things. And I can put these other values back to where they were, and you'll see that it's still a very big swing, right? So we're, you know, in this case, going from 21 to 31.5. That's an 11.5% or 10.5% improvement in the return on equity, instead of a 3.5% improvement just for the same amount of revenue change. And so when you want to know why is it that a company might do this, that's kind of the reason, is as they get more risky, it will cause their return on equity to go up in a lot of cases. Now, it will also cause the return on it, in particular, if they can do that at the same time that they're growing their revenue, it'll really grow their return on equity faster. And so that's the other thing that they like. All righty. Want to talk to you just a little bit about how all of that sort of feeds into the concepts of risk that we talked about. Remember, we're talking about starting out with some variation in revenue. And that variation in revenue for a company, we now know from the leverage discussion, creates a variation in earnings. You should also recognize that it creates a variation in liquidity and how much cash you have, because a certain amount of these earnings turn into cash. And so you can now kind of trace this down and say, so we started out with an operational risk maybe, or a market risk, depending on how you want to think about it, but perhaps an operational risk in terms of the variability in our revenues. That created variability in our earnings and variability in liquidity, so now we have a liquidity risk, right? And the liquidity risk, just follow that one down, creates a risk to the firm because they may not have enough money to pay their bills. It also translates in a risk to the debt holders that loan money to the firm because they may not be able to get paid for what they loaned, and so now they're concerned with the if there's higher risk, that there's a chance that they may not get paid, and they may need to raise their interest rate on any future debt that they offer to the company. Then over here you got variations in earnings, and again that could be a risk to the firm. That they have negative earnings, and that starts to destroy the asset value of the firm. And of course, that variation in earnings is something that causes the stock price to vary, and stockholders perhaps don't like that variance in the stock price so much, and so that creates a risk to the stockholders. And so, this whole variation in revenue plus this leverage is really the root of all of the business risks that you need to think about for your firm. I want to introduce one last concept here and that is the concept of a levered versus unlevered beta. Um, Levered is sort of their term that's similar to leverage, and it does have the same concept to it. But this is the other way that this term is used. Isn't exactly like the leverage that we just talked about. And so, think about it this way: when we use the capital asset pricing model or the arbitrage pricing theory, um, we're getting our betas by basically looking at what the existing stock price is doing in the market and what the returns on that are, and comparing that to a market portfolio. And so what that means is that the beta of that stock price reflects the riskiness of the company as a leveraged company. So it doesn't have a degree of leverage of 1. It has a leverage that's higher than that. All right. And so, we can see that degree of operating leverage and financial leverage eventually trickle down to the stock price and affect its risk. And that would be true whether it was systematic or not, right? That it affects the earnings and the stock price. And so it would be true even in a CAPM world or a APT world where you only care about the systematic risk. So it is possible to unlever the beta value of firms that have different debt structures, so that you can compare what their risk would be, but for this. Now, in this case, when you're unlevering the betas, you're unlevering the stock price beta, so it's not unlevering the earnings risk or the revenue risk, and you're unlevering it. Just for debt. So you're really unlevering the financial leverage, not the operating leverage. So now when you talk about that inherent riskiness, you're talking about the riskiness inherent in the variability of the revenues and how that translates into variability of net operating income, and not so much about what's going on with leverage, financial leverage. Okay, so a lot of times we might want to do this when we want to compare two firms that have different financial structures, different debt versus equity structures, but they're kind of in the same business. And so we want to get them to a point where we can say, are they really about similarly risky, but for that debt structure choice? Or is there something else going on that's making one more risky than the other? And so we use this unlevering approach, but it looks a little bit different. We don't use the degree of financial leverage here. We use a slightly different method. It's a similar concept, but we're doing that because we're not unlevering the earnings, we're unlevering the stock. Okay. The other way that this kind of approach, this levered and unlevered beta approach, really comes in a lot is that, let's say that you've got a non-public firm, so it's not traded and therefore you can't get the beta for it, but you want to value it or understand what its value might be for some transaction. Well, if you can go get the beta of a public firm and unlever it and make the adjustments for that, then you could approximate the beta and therefore the value of the other firm. So let's just go through an example here. Consider a firm A. It is a private firm, does not have traded stock upon which to estimate a beta. It's only 10% debt financed, and its tax structure is such that it only pays 25% taxes. How are we going to get a beta for that company so that we could go in and value a project or estimate equity or whatever else? Well, one way we could do this is we could go find a firm that's in a similar industry and that we would expect might have similar revenue variability, similar degree of operating leverage, and then we could sort of solve for what the implied beta of that firm B is if we unlever it for financing, and then we could go take that and relever to look more like the company A. All right, so it's a little bit complex, but here we go. Here's the simple example. So the first step, we unlever the beta for firm B, then we'll relever it. So the formula for this is that the unlevered beta is equal to the betaed lever, or the levered beta, so the beta that you get from CAPM or APT, divided by 1 plus whatever the debt equity ratio is times 1 minus the tax rate. And so you do this part first, and then you add 1 to it. Okay? I know there's not a particular intuition for that formula, but that's what's going on. And really, what you're doing is picking up the debt versus equity relationship here. And the 1 minus tax rate is in there because remember that the interest is tax deductible, and so the difference in tax is important here. Okay? So if we did that for our example with firm B, we would say, oh, well, let's figure out their unlevered beta. Their levered beta was 1.7. They were 60% debt financed, which means they must be 40% equity financed. Their tax rate's 35%. So I plug that all in mathematically. I come out with an unlevered beta of 0.86. Well, 0.86 is a lot different than 1.7, right? Their unlevered beta is less than the market portfolio's risk. It's the amount of debt financing that they have that has pushed them to be more risky than the market portfolio. Now, assuming that once we look at all of that, we think that the other firm that we want to lever back up is similar in terms of its revenue variability and kind of the factors that are driving that, and it's similar in terms of its degree of operating leverage, then we could arrive at a levered beta for that firm by just reversing the process. So we would take that the levered beta is equal to the unlevered beta times all this business instead of divided by it. But we need to put in the values that are correct for firm B here, right? For firm A, sorry. So remember that for firm A, it's only 10% financed. So 10 over 0.9, so 10% debt, 90% equity. And it only has a tax rate of 25%. So when you plug all of that back in, you wind up with a levered beta for that firm of 0.932. Now, a couple of things cool about that, all right? The first thing that's cool about it is you've now found a way to figure out a beta for a company whose stock doesn't trade, all right? So that's not too bad. The second thing that's cool about that is that because you went through this process and were careful about it, you didn't ignore all of the issues related to the tax structure and the financing, and you came back and basically recognized that this is a lower risk firm. Remember that on a levered basis, that firm B, that you thought was the comparable firm, had a beta of 1.7. You came out with only a 0.93. So very big difference. The leverage, the debt to equity relationship and the tax relationship both made a huge difference in terms of what you actually wind up with. And so could fundamentally change the sort of way that you think about what the firm is worth and whether you would buy it, for example, or sell it for a particular price. One last concept, and I'll let you guys go. I know this is getting long. I want to talk to you about, given the implications of all of this, what could a firm do if it said, I don't like my earnings variability and I would like to do something to reduce it? Okay, so kind of start from the model that we have. Remember, there's revenue variability, operating leverage, financial leverage. All those contribute to the earnings variability. So anything we can do to reduce the revenue variability. Well, companies do a couple of things there. One is, they are trying to figure out a way that their revenue won't vary so much as the business cycle varies, and so they could enter into longer-term arrangements with their customers that maybe make sure that a certain amount of their customers continue to buy at the same levels, even in downturns. And so some companies do that. The more common thing that they might do is they might diversify their revenue sources. So they may go buy other businesses. And so if I've got a business that in some situations tends to have higher revenues and in other situations lower, I'll go maybe put a second business in my portfolio as the corporation. So I'll buy a different business that is what we would call counter-cyclical to that one. And so the two revenue levels offset. And so it's the same sort of diversification that we talked about with the stock, but in this case, it's just businesses. And by doing that, they reduce the overall revenue variability, which by itself will reduce the variability of earnings. Separate from that, they could say, well, let's reduce the degree of operating leverage. We know now that you can decrease the degree of operating leverage by eliminating fixed costs and going to more variable cost. And so some examples of that are you might convert from, say, a lease that has fixed expenses to it to a purchase where you have no necessary fixed expenses on an ongoing basis. Particularly if you have the cash to purchase it and you don't even need to borrow money for it. All of a sudden there's no expense associated with it at all, and that becomes nice. You could do some sort of revenue expense sharing. Folks do that, and so imagine that as I've got a vendor, and instead of them charging me some fixed cost to come and do some service every so often, they agree that they will take the risk with me, and they'll just accept some percentage of whatever my revenue is in return for their services. And so that takes the fixed cost away and makes it variable. The other thing that is obviously done a lot in terms of businesses is in the compensation of your people, where rather than paying them a large salary base, perhaps you pay them a smaller base and you shift more of their compensation to be performance based and maybe tied to revenue generation. And so that makes the labor cost less fixed and more variable for a lot of your business. So all of those are things you could do to reduce the degree of operating leverage. And then, of course, you could reduce the degree of financial leverage by either reducing the amount of debt that you have or lowering the interest rate on that debt. Remember that for the degree of financial leverage, that it's about the dollar value of the interest expense. That's what's driving that leverage. And so you could do it either by reducing the overall debt or by reducing the interest expense, or both. Anyway, that I wanted to make sure that's a lot, I know, but I wanted to go through those sort of concepts of leverage and how they tie back to risk and the CAPM and APT and all that sort of stuff. Appreciate your patience. Thanks.